Hello, everyone. Thank you so much for being here. My name is JJ. You're watching Bull Boom Bear Bust. I watched the entire FOMC meeting today. We're talking about Jay Powell and his crew of money printing monsters. Um, that's what I like to call them. Anyways, let's talk about what was said at the meeting. And there's a lot of things that I heard that were very concerning. And I think once we get to the end of this, I think you'll agree. Now, I don't have the screen share up today. I know some of you are saying that you like the screen share where I bring up the articles and I play the videos and stuff like that. I'm having a little bit of difficulty, or a lot of difficulty, with the camera that I use, because when I do the screen share, I have to do it on a PC as opposed to just these videos where I sit down and talk. I do it on a just a separate camera, separate from the computer. So let's talk about what was said today and some points I wanted to bring up here, some questions I wanted to ask you, and I'd like to hear from you down in comments on some of the things we heard today. So Powell had the speech. He started off for 10 minutes just speaking without answering questions. I believe it was about 10, maybe 12 minutes in, he started taking questions. I'm going to talk about that here in just a little bit. But at the beginning of the video, he was fixated on just one spot. Usually if you're speaking in front of a crowd, you're going to be looking around at the audience. He wasn't doing that. So something tells me he was reading off a teleprompter. He had his eyes focused in one spot. Now, at one point, he was looking down at his notes, but we saw this in previous speeches where he would look down at his notes and look back up at the crowd, look down, look up. And of course, that tells you that he's just reading off of a script. Today, I think it was less noticeable, but he did have his eyes fixated in one spot. So I think he was still just reading off of a script. Maybe he's just doing a little bit of a different way of doing it, maybe to try to get people to believe that he's actually reciting, things from his own mind instead of just reading a script. Anyways, I thought that was interesting. Rate pause, no hike, which is very interesting because more than once, actually, I counted 3 different times, Jerome Powell said, this has been a resilient economy. He said it once during his intro dialogue, which was about 10 minutes, and then he did it a couple more times as he was answering questions from the crowd, which was mostly reporters. We'll talk about the types of questions here in a few minutes here. The Fed says this has been a resilient economy. Okay, if the economy is so resilient, let's go ahead and raise rates, because here's something else he said. Quote, we have a long ways to go. A long way to go is what he said. That was a quote. So think about this. If we have a long way to go, and he's talking about the fight against inflation, if we have a long way to go, why are we pausing rates? Well, let's just raise rates. If you're trying to get from point A to point B and you have a long ways to go, you want to stop and have dinner, or do you want to just keep going? Now, maybe stopping and having dinner will give you more energy to get there faster in the end, but that's not what they're doing. They're pausing. And what good is a pause if you have a long ways to go? You're not getting anywhere. Now, this was the first time since 2020 that there's been 2 consecutive FOMC meetings without some sort of rate decision, up or down, but just with a pause. The first time since 2020. So we're at a point now where we were in 2020 with all the uncertainties out there in the economy, yet Jerome Powell made it sound like everything's fine. The economy is doing very well, resilient. The consumer is resilient. We heard that again today, except to use the word strong. With all the debt out there, it's just amazing that these people, Jay Powell today, got up there and is able to say these things with a straight face. So that's why they have to hire someone that's really good at living the lie or speaking the lie, and less about knowledge about the economy. It's more about how well can you convey a message without laughing or without blundering or stumbling to make it look like you have no idea what you're talking about. Somebody that doesn't really know a lot of what we know on this channel. I'm talking about we. When I say we, I'm talking about you, my audience. I think most of you in this audience probably knows more than he does, or if he does know it, he's not leading on to how much he actually knows, because if he were to know what we know, then there would be a lot of things that would be different. Look at all just the money debt creation over the past 10, 15 years, the rock bottom interest rates. So you created the boom in the economy, but now you're afraid of the bust, so you're afraid to raise rates even more, even though you're admitting you have a long ways to go against inflation, but yet you're pausing rates. And that's another thing that was said today. He said the Fed's mandate is strong job growth and an increase. He said the Fed's mandate is strong job growth and stable prices. Well, if you want to look for stable prices, don't look to the United States. I mean, look at the housing market over the past just 5-10 years. Look at anything. Prices are anything but stable. In fact, prices are just the opposite of stable. We've seen some pretty massive inflation, so they have not met most of their. He says these are mandates, right? So he says these maximum job growth. But then he also went on to say we have an increased supply of workers that are leading or helping the strong jobs growth. So is it because we have a lot of new people coming to this country? And is it because they're taking jobs that other people may not want because the wages are so low? Could that be part of the strong job growth? And ask yourself, could that be part of the strategy for making the economy look better than it really is, touting all these new jobs because we have all these people, coming from other countries, a lot of poor people, and they're taking these lower wage service sector jobs, which is mostly what the U.S. economy is low wage service sector jobs. Now, the term low wage, that may mean different things to different people. Look at fast food wages out here. I believe the minimum that's going to be allowed for fast food places in California, I want to say out here, I'm talking about California, a $25 minimum wage for fast food workers. So when you say low paying, that's actually still low, though. $25 is not making very much considering the cost of living here in California. But anyways, I thought that was interesting as he mentioned the increase in supply of workers. Now, the quantitative tightening is continuing. They have already shed about $1 trillion off of their balance sheet. We're under 8 trillion now. We started off just about close to 9 trillion. And the Treasury roll-offs are going to be capped at 60 billion per month. A mortgage-backed security roll-off is going to be capped at 35 billion per month. So when you look at the size of the balance sheet, that is a very, very small roll-off or shedding of the assets from that balance sheet. In fact, the tightening that's being engaged in right now is a lot slower than the easing on the way up to $9 trillion. Quantitative easing, when they're increasing, when they're buying everything under the sun. Quantitative tightening is when they're shedding assets from their balance sheet. To me, it looks like it's a lot slower with the shedding versus what it was with the purchases on the easing. Now, because the central bank is no longer buying like they used to, we're seeing yields spike. So to attract real investors, there has to be a bigger reward and a bigger yield on these assets. It needs to be given out. Otherwise, no one would be there to buy them. Now, I still think it's the inevitable conclusion that there's going to be some sort of emergency rate cuts. Now, there could be a couple things that trigger this. It could be the consumer. And everywhere you look right now, the consumer is getting more behind. Auto loans, student loans, they were paused for 3 years. Now we'll see, but just in October, they resumed. So we'll see how that goes. But auto loans, credit card payments are delinquent more. I should say the amount that they are delinquent is increasing. It's getting worse. Foreclosures on the upswing. And 2 reports ago, bankruptcies on the upswing between 10 and 20% year over year. And some of these things, a lot of these things, if you look at history, they start off very incremental. It's a 5%, it's a 10% increase versus last year when we're talking about delinquencies with loans, late payments. But then it gets to a point where it skyrockets, right? So it starts as a trickle, and then it turns into a waterfall very quickly sometimes. Sometimes in a matter of months, you see this number year over year. It goes from 10% to 25% to 50%. And then all of a sudden, a few months later, you're doubling, you're 100% versus the prior year. And that's when everybody finally admits that there's a big problem. Well, we can see that we're approaching the wall, and we're not slowing down near fast enough to avoid it. In fact, I don't think we can slow down to avoid that wall. But what's going to break first? Is it going to be the consumer? We see a mass tsunami of defaults and late payments and car repossessions and foreclosures, late credit card payments, surge in bankruptcies? Or is it going to be something within the financial system where you see the entire credit system freeze up? And we know the banks are insolvent. They loan out money they don't have. So it's just a matter of time. It's not a question of if, it's a question of when. And people still ask me, what do you mean banks are loaning out money they don't have? How do they loan it out if they don't have it? Well, think about this. What if someone gave you a calculator and they said, okay, as much money as you want to type into this calculator, that's how much money you have, and you can loan it out to people and charge people interest on that, and they have to pay it back with interest. That would be a pretty good gig, right? So that's what it is. Ask yourself, the last time you took out a loan, did you walk out of the bank with a bundle of cash, with a bundle of bags of coins? No, of course not. It's all digits. It's all digital. They're transferring funds from point A to point B, in this case in the form of debt, from the bank to you, the consumer. And instead of just pushing buttons to create this money, you actually have to work and pay it back with interest. Right? So just think about it like that. I still get the question. It really blows my mind that people are still asking that question. So yeah, the banks do not have the money. In fact, if you look at all the money in existence right now, it's 90% digital, right? Less than 10% of all the money out there is physical bills, meaning cash or paper or coins, right? So that's how loans are being given out right now. It's digits on a screen. They don't actually have the money, and they're able to create these digits without any sort of backing. So they don't even have the money in the vault that they're loaning out in the form of digits on a screen. So it's no wonder we have inflation. You have to flip around this whole financial system and monetary system in order for this not to be inflationary. Yes, they can tighten. They can tighten the way loans are given out and make it more difficult to get a loan. And that's happening naturally right now, just with the levels of debt consumers are carrying. The higher rates make it to where the monthly payment's not affordable. That's why we see record sales. What, a 20 plus year, we see record sales. I used to work in a record store a long time ago, when people used tapes. Remember tapes before CDs came out? Yeah, that's how long ago. Might be aging myself a little bit. What I meant to say was home sales, not record sales, home sales, 20 plus year low. Many people priced out of the market right now. So we're seeing home prices start to come down. But at the same time, we're told that this is a resilient economy, that everything's fine. The consumer's strong. The consumer's strong at borrowing and going further into debt. So if you want to say the word strong, sure, you can apply it to those two things. The consumer is strong, strong at accumulating more debt, strong at depending on credit cards to get by, strong at becoming later and later on these payments here and becoming more delinquent. So that's the type of strength when you look at the U.S. consumer right now. All right, so what do you guys think about this, the meeting? Did you watch it? What did you get out of it? I heard a lot of contradictions. So the economy's strong, the consumer's strong, but yet we're afraid to raise interest rates even 1/4%. Folks, it doesn't add up. Something's very, very wrong. Keep stacking, because we have a day of reckoning ahead of us. It could be all at once with a systemic failure in the banking system, with all these banks that are severely underwater on their assets here, on their loans, on their book of loans, severely underwater. What's being put out there to the public is, oh, look at the profits, but you have in the background big time assets that are underwater without the buyer there. We're talking about the central bank, without the central bank being there to buy up all these bad loans like they used to do with the quantitative tightening that's happening right now. So that's what's going on, folks. What did you think about the meeting? And what's going to break first, the consumer or something in the financial system or the banks? I'd like to hear from you down in the comments on this one. Thanks, everybody, for watching. Please hit that button right over here. That is the subscribe button. Hit that like button. It helps get this video out there and get it some traction. You really help out the channel if you do that. Thanks, everybody, for being here. Bye for now. Keep stacking. Peace.